Hello, everyone. Welcome to the second SoFiE Seminar this semester. Today, we have a real feast. All right, Professor Jianqing Fan from Princeton University is going to give a talk on high-frequency trading, high-frequency prediction, followed by a discussion by Professor Torben Andersen from Kellogg. And we will have 40 minutes for the talk, followed by a 12 minutes discussion. And afterwards, we'll have an informal session. All right, Professor Fan, the stage is yours.
Okay. So, Dacheng, thank you for a nice introduction, and all of you organizers for an invitation. It's my great pleasure to talk on the ongoing paper with Yasin Aisa Halia, Li Lonxue, Yifeng Zhou. So the last two were my students. They're both now in Wall Street doing the real thing rather than the academic talk. So here is my outline. So first I'll give, the brief introduction, followed by the data and methods. Then I'll tell the result in three aspects: predictability of individual stocks by the environment and determinants for predictability. And then lastly, answer what is the economic value of timely data. So, well, the high-frequency trading has grown substantially over past decades, certainly bring big data into the financial world. So by the 2015, high-frequency trading accounts for more than 50% of trading volume in the US equity markets. So certainly high-frequency trading have profound impact on ever-growing market microstructure, draw much attention on the limited order book dynamics, and there has a couple of papers on building parametric models, how the market limit order dynamic move, not necessarily directly on the prediction of returns. So a natural question people may ask, does scalable non-parametric methods, that is being called machine learning methods, has an edge in such a kind of predictability problems? And this is really ideal environment because we have really big data, complex mechanism. And in particular, you may ask what kind of thing can be predicted and what are useful predictors and what are the environments that influence the predictability. And so there are certain, we are not alone, in this vast literature. There's a lot of papers on, using statistical machine learning methods to predict on stock, characteristics such as trading volumes or price jump and so on, and all on the return and the price itself. And most of them really showcase the machine learning method works with relatively limited sample size. So our question is the following: does predictability exist in high-frequency finance? And if so, what can be predicted? Of course, we cannot exhaust all of those. We just showcase a few aspects. And then the second question naturally asks, is predictability universal? You are only lucky on certain days for certain stock, or is really universally predictable? If so, how much can you predict? And then, of course, people naturally ask, what are important predictors? And then further, probably more interesting is, what are the determinants and the environments that affect the predictability? And what is the value of data's timeliness? Either you were being able to look in forward, or you were able to, delay, or you were not, you delay your getting your data. So here, to answer these questions, so we use tech data from, for past 2 years, 2019 to 2020. So there's total 505 days. And we use the average stock, right, in SP 100. So that gives us about 2.3 terabyte data. And this is one example of transaction data, and particularly we'll use lead already, type of inferred trade directions. And this is the code update type of data. level 1 data. And so here are summary statistics. So summarize what is the typical volume, right? So how many data per day, how many transactions, right? How many quote updates, right? What is the trading volumes? What is the nominal price? So these are, we are all involved with big price, right? So the average SP 100, I think in 2009 is about 185, just nominal price. It does have impact because the spread is 1 cent, right? Then it's also summarize all different kind of returns using different kind of time clock. So I'll introduce what is the time clock, right? So the time clock we use is calendar time, transaction time, or transaction volumes. So in particular, we maybe test our return in 5 seconds or 30 seconds, or in 10 trade, or in 200 trades, short and long, or I mean, like in the transaction, let's say volume clock, 10 lots or 200 lots. So these would be the time interval that we and the clock mode that we use and define correspondingly the time interval, right? So for example, what is the, how long does it take to get 10 trade completed, right? And so on. And then the particular one that we were, we were doing, or we trying to understand is the trade returns. And what we use is for any given time mode, that could be 5 seconds, or could be, let's say, 10 trade. Right? So we use the average transaction price in this interval, in the time interval, relate to the time clock mode, divide by average the mid price at time t, and we use this to define as a return. And then, of course, we also measure by the trade directions in the sense that whether the return in that particular interval is above the average or not. And then the average typically is 0. So basically saying whether the return is up or down in a particular time interval. And we also trying to predict the trade duration in which we really define, I mean, mathematics look a little bit abstract here, but really saying the time it takes to execute, let's say, 20 trade or 100 shares. So these are 1,000 shares, right? So this is the trade duration that we are using here. So for any given variable that we create or crafted, so we use different time intervals. We could use past 0.1 second, or I mean 0.1 to 0.2 second, right? So 0.2 to 0.4 seconds, and so on. So it's like a very, just look the very, near near the past, a little bit more remote and further remote. Right? So for transaction clock, we could also look at the past one trade, right? The time taken to complete part 1 trade, part 2 trade, and so on. So this is the interval that we defined. Now here are our crafted feature. Each of those have a little bit more, more precise definition, but here I just give you the idea. So we use breadth, defined as number of transactions in a given time interval, any of these kind of time interval here. And the speed of transaction is the time it takes to complete this many transactions. And then this is, so all those are related to the intensity. So this is the total volume traded in that interval. This is the average volume traded in that time interval. And this is the maximum volume traded in the interval, just to capture some kind of block tradings. And then we have return and particular imbalance related crafted variables, right? So this is the maximum, the price change in that interval divided by total volumes. And this is the limited order imbalance type of variables, which is the average of B and R spread divided by the average price there. And then we have transaction imbalance, which is defined this way, that relate to to the volume and so on. This is the past return. So these are the the crowd feature that relate to return as well as imbalance. And then we're also using other characteristics, such as turnovers, autocorrelation of the transactions, and then the quote spread, and the effective quote spread is basically volume weighted quote spreads. So in total, we have 14 variables, and then each variables we look back in 9 different past time windows of different lengths, right? And then plus intercept, right? So they have 127 variables. And so it's not really like high dimensional problem. It's, given the data availability, really regularization not as important. But on the other hand, we really want to know which variable play an important roles. So therefore, we decide to use lasso, because lasso is one of the simple methods most people know, and people can select a variable for predictions. And so this is select among 126 variables. And then, of course, this is classical random forest. So we use random forest as a non-parametric predictors. So we choose random forest. But on the other hand, we also try other methods like gradient boosting tree, farm predict, and so on. So the result will be similar in our robust studies. So now the question is, once you do prediction, so what is our measure assessment of predictability? So what we here use as what other people would naturally use is outer sample R squares. So the only one difference is that we in this outer sample R squares, the number here, we are using infeasible sample average of testing data rather than the training data. So in other words, what we really report here is the prediction error, right? So normalized by, this in comparison with this infeasible, the infeasible future average of testing data. And we also measure the goodness of or success of our prediction by using the sign. So, right, if there's both of their signs are consistent, we add in 1, otherwise there's 0. So in other words, when we talk about accuracy, we didn't really build any model like logistic regression type of model to predict the sign, but rather just using our regression and then just check if you predict direction right. So accuracy is another way of measuring our prediction. And in order to train the model, as usual, we do training and testing. So we use 5 days as a training and 1 day as the testing, and then you just move in the window forward. So in order to to getting a tuning parameter, we use 1 month before to train the tuning parameter. So again, we are doing like the 5 days, the training, 1 day, 5 day prediction, 5 day training, 1 day 5 day prediction to select the tuning parameter that relate to lasso or random forest or any other methods. So now let's talk about predictability of the stock return. So first, we ask ourselves, do we have predictability over time across different individual stocks? And here is the first results that I summarize here. So for each individual stock, I aggregate over our prediction period. This is the 2-year period in 2019 and 20. So therefore, for each individual stock, it will contribute one of average or median outer sample R squares. Right? So and then now I just summarize the result here. So I have 505 stocks. I have 101 stocks. So this is the distribution of outer sample R squares. For 101 stocks, and this is using random forest, and this is using lasso. So apparently random forest slightly outperform lasso, and this is for 5 seconds return for the relatively short return, but it's also pretty long in high frequency world. And this is for 30 seconds return. This is in terms of calendar clock, right? So I can also use in the trade clock, right? So for 10 trade or 30 trades, so this is 10 trade and these are 30 trades, right? So short time and a little bit longer time. Again, random forest seems to outperform Lasso. And then this is for the volume clock, 1000 and this, right? So if we're looking at this, we can easily see that predictability is universally exists. And if you're looking across this, so for like a 5-second return, short-term horizon, so the average predictability is about 10 out of sample R squares, and it decreases over time horizon, as we can see and can imagine too. And here just summarize what are the important variables, right? Aggregate all those stocks and aggregates all those stocks and the 505 days. So these are the variables. They are very small here. You probably cannot see, but the first one, most important one is transaction imbalance. And the second one is the past return. The third one is limit order imbalance, and so on. Right? So these are, I'm summarized here, transaction imbalance, the past return, and the limit order, and lambdas, so the trading speed. So anyway, so and these are the average Lasso coefficients. Amazingly, thanks to Lasso standardization, automatic in the software, right? So Lasso's coefficients average across, I mean, the 101 stock, and also across, across 505 days. So it's very clear. Their coefficients are highly significant, and as you could imagine, the most intermediate time is the most powerful predictor. I mean, the closest to the current time is the most powerful predictor. So a quick summary of what we said is that the median R square for 5-second prediction is 0.1, and this also holds for 10 trade and 1,000 trades. The predictability decrease over time, and important variables including transaction imbalance, past return, limit order book imbalance, and the more recent, the better the prediction. And then if you are curious, what is the predict direction in terms of assessment predict direction? So they are 64% correct. So if we aggregate everything else, and we do similar exercise for, duration prediction. And the duration prediction is, is also have about 10% of duration. And then in this case, longer horizon, a little bit easier to predict as you could imagine. And then these are all the variables that relate to volume related variable that for duration prediction. Now we summarize again individual stock performance, but now across time, right? So in other words, for 505 days, I summarize what is the average. The average, or indeed its median, out of sample R squares associated Popper's area with this standard deviation. So you can see that for every day, the predictability is universally exists, right? So 0 is here, and here I'm just showing you what is the SP100 index volatility, and this particular time you can see is the COVID-19 period. So higher volatility certainly associated with weak predictability. This is at least what we can see from here. And then this is similar, just summarize the accuracy, the sign accuracy across different stock over different days. Right? So this is the duration prediction. Okay, so and now you may curious, are there any sector that's easier to be predicted? And from our exercise here, so it looks like predictability is approximately constant across different sectors. And then we also try other machine learning methods other than the ordinary least squares, which doesn't perform as well, even though it's not the, even though we have plenty of data. Other than that, yeah, all other statistical machine learning methods work quite well. We also tried deep neural nets. It just takes too much time to tune well, so we didn't really tune successfully on that. Now you may be curious, what is the time interval that have better predictability? Well, so we divide the time into three different, different zones: 9:30 to 10, 10:30 to 3, and the 3 to 4 o'clock. So in that aspect, so if we divide into these three different time intervals, and so we only use the same data in the same interval for training. So if we look at this, so we showcase only Intel in this. So what is the most predictable is the 3 to 4:30. So I think it seems to me the most predictable, and the least predictable probably is the morning trading. So 9:30 to 10, and so on. So now let's look at the determinants of the predictability. And in particular, we look at the stock's own characteristics, and also look at cross-sectional factors. So here is, we examine, the first one is the nominal price, right? So we are plotting average predictability versus, a daily average, share price across 505 days. So we have 101 symbols here, right? So this is the nominal price. And since the minimal price change is 1 cent, right? So smaller nominal price must means bigger bid-ask spread. So the most predictable one, the top three, is Ford, right? So the average price only 8.1 cents, and then followed by GE is 9. Right, and then by the KMI here. And the most, as I said at the beginning, the average $185. So these are very small stocks. So this is the log price, and from here we can see that the bigger stock, right? So the smaller predictability seems to be like the impact spread is reflected here. Now, in terms, so this is for the accuracy. So accuracy is very similar, right? So the smaller the stock, the better predictability you have. So as you increase this, as stock getting higher, so the negative association can easily be seen. But on the other hand, that if you look at the duration prediction, in terms of volume, so the bigger stock is more liquid, so therefore duration is better predicted. So in order to check the effect, we also do panel regression. Right? So let me take 5-second return as an example. Of course, you can apply to 5 seconds duration, and let's say 10 transaction duration, and so on. Right. So this is the nominal price, certainly after adjusting for simple effect, means individual stock effect, date effect, right? So outer sample R squared is 0.71. After adjusting all those, the nominal price clearly have negative impact, as we see here, on the predictability. So similarly, we examine other characteristics. So as an example, I talk about impact on liquidity. So impact on liquidity can be measured either in terms of trading volume, trading volume in terms of dollar, or average spread size. so this is outer sample R squared returns. Again, this is trading volume in terms of dollar. So the bigger, I mean, that you have clear negative association here, and this is similar. Accuracy is looks more clear, negative return, and this is the duration certainly has a positive return. And this is the spread, right? So the average spread. So the bigger the spread size, I mean percentage of spread size, the stronger the predictability that you can see here. And again, this is for directions, and this is in terms of volume. So in other words, liquidity is negatively associated with predictability, and the spread is possibly associated with it. Again, this measures the efficiency of market trading. And we do similar things, right? So doing the panel regression, adjusting the, I mean, this we call symbol effect, the stock effect, and the day effect. But after adjusting this, I mean, these both trading volume and the proportion of spread has significant impact on, so it's on the predictability. So in all those exercises, the outer sample R square is our target. Right, so we have 505 days and 101 stock. Right? So this is the same applied to direction and I mean the duration prediction. And similarly, we try other things. Let's say we try the volatility of each individual stock as measured by 15 seconds return. We also try to see if, let's say, the stock has a big change.
I'm in the middle of giving a lecture.
We also try the yeah. So the different I mean intervals. Let's say from yesterday to whether today's price is 3 to 4% above yesterday's price. I mean the change day-to-day change is in this interval or day-to-day closing prices in this interval, because if there's a big change, right? So the dynamic that we learned before may not necessarily, remember we use 5 days to do training, right? May not necessarily, apply to today, right? So in other words, we are just seeing if there a big change in dynamic from day to day. So we do this regression for 5 days as we would expect it, right? So the more volatile stock is harder to predict. And this persists even you adjust for, I mean, different kind of jumps from yesterday to today's like this. But and that's also applied to directions, or I mean prediction of directions or prediction of transactions and so on. So this is okay. So and then of course you.
So Professor Fan,
yeah.
Maybe it's a good time to pause for a quick question.
Sure. Yeah.
Right. So let me say the question. So there is a good question from Paul Besson from Euronext. So he asked on page 27, could you interpret why the OLS underperformed so much all other ML algos? Is this due to the nonlinearities? Did you try the OLS on the set of variables selected by Lasso? Are results still lagging so much?
Okay, so yeah, this very very good question actually. While I was talking, I was also a little bit surprised that YOLS actually, underperformed. Yeah, so it's a little bit given the data, the sample size that we have, it's a little bit harder for me to take that, to exactly view that. And indeed, if you look at, let's say, 5-second returns, they are looking fine, right? So they are looking well. And then this is related to, and then for, let's say, 30-second return, it's only on these like a trade related. So when I was giving a talk on this, I really puzzled why it's so bad. That's a good question. So I will certainly check, asking my student to check more precise. Now, whether we use what's so-called post-lasso, that is apply the variable to to the lasso selected? I believe we don't, because we are not in the situation of, let's say, over parameterization. It's a high frequency data. There's a lot of data to do training. So the only thing I can imagine, if OLS doesn't work as well, could that be due to like a non-robustness issue or something in the fitting? Because we use 5 days data, and the stationarity of data sometimes may impact on that. I'm not sure, because lasso is more regularized, right? So in fact, you use less variables. So all other methods more regularized, so probably more stable. That's the only thing I can speculate at this moment, but I'll definitely check on this. Good question.
All right, let's continue.
Thanks. Okay, so we do similar on the, let's say SSI pricing characteristics, like using 15 seconds return for each individual stock. I can calculate market beta with SP500, and then the R squared with SP500, or idiosyncratic components with SP500. So all those really only relate to correlation and the volatility. So again, if you do this, so you can see that all of those have negative association, and it's understandable, right? So if you have bigger beta with SP500, and we know that the market components is harder to predict, so all those negative signs seems reasonable. And we also check the impact on market conditions. So in particular, let's say take VIX as example, in the highly volatile markets, so it's harder to predict. And in this case, I can always adjust each individual stock, but I cannot adjust for date effect, because every day, every stock share identical the same market environment, right? So you cannot have both date effect and then VIX effect, right? So instead we replace it by data effect, which really means that is an indicator variable, whether is these FOMC announcement dates, or labor department's employment data dates. So this is the data dates. So certainly it does have impact, and this is the best adjustment we can make. But you can see the VIX does have negative association with all of those predictions. Since VIX and the return are negative associated, so it doesn't surprise, everything here will become positive too. Okay, and then we do panel regression just to see if all those individual marginal effects that we see are persists if we account for other variables or other attributes, and is clearly all those magnitude and also statistical significance still there, whether you're talking about 5 seconds returns or 30 seconds return or 10 transaction and so on. So this the results here showing that those are persistence. And we do the same thing for duration exercises. All those results seem to me universally exists. So again, whenever you adjust for, let's say, SP500 return or VIX, right? So you cannot use date effect. You have to use data effects. That's the best you can adjust. So that's what we seeing here. So all those persists. So let me just summarize. We say a lot on this part of result. What kind of environment and determinants affected the predictability? We basically saying impacts on individual determinants are similar even after accounting all others variables. And what kind of stock are easier to predict, right? So for less liquid stock, so nominal price low, right? So for less volatile stock, and for smaller nominal price and the less correlated with the market. So if for these attributes is easier to predict, which is in line with what our intuition suggests. And the date effects account considerable for R squares. So that means the predictability change also a lot from date to date. And so the stock effects, so it's also changed a lot across different stocks. So similar remark apply to duration predictions. Again, if you examine the sector effect, the sector effect is very small. So now the last part.
Professor Ben,
yeah.
Would you like to take another question from the audience directly? All right, Imuzi Lazar, would you like to ask your question?
Oh, sorry, my hand was raised by mistake. Sorry, thank you.
Oh, okay, sorry about it. Let's continue then.
Okay, so now my last part is the value of timely data. So again, we want to quantify, since hundreds of $millions being, spent from Chicago, right? So where Dacheng and Torben is there to my place, right? So naturally you ask yourself, what is the time value, right? So in this case, I'll take Intel as an example because it is a typical size and also very typical in SP 500 index. So all the results based on Intel's stock. So in this case, I trying to do first trying to do the lifespan. Right? So we were doing 5 seconds. How about I do predictability for 1 second, 3 seconds, right? 15 seconds, and so on. Right? So this is the results that we do for different time spans. So when you predict too long, let's say about 203 minutes for Intel, I think the predictability is 0. So even before that, predictability is 0. And then this is the for the return prediction, I think, and then this is this is a different time clock. This is the transaction clock. I think peak around here, maybe about 200 trade, and then this is the volume clock, and this is measured by the similar thing for the duration. So from here, we can see that, of course, if you predict too long, there's no predictability here. And in terms of trading volume, there's a sweet spot here. I cannot explain myself. 20 or 2000 is the sweet spot that you can predict here. And then for us, more important, we want to see how about the time delay, right? So in other words, due to the communication delay, I'm not necessarily being able to use the data from 0 to 0.1 seconds, right? And so on. So here we try like some kind of time delay, or either due to your hardware processing slower than others. So the predictability, I think, decreased already quite something from 15% to maybe 12% if I delay by 0.1 milliseconds. And by 1 milliseconds is, it's less than half as high. And if you go delay to 1 second, there's nearly no predictability here, and no predict here. So delaying 1 milliseconds will reduce more than half of the predictability. And this is similarly in terms of transaction clock. So if you delay by 1 trade or delay by, let's say, 5 trades and so on, so it's decreased very quickly. So this demonstrates the time value of predicting the returns. And here is the accuracy, measuring the similar thing, measure just our simple R square accuracy. So it's in line with the return prediction. Now the other thing is what we were trying is, what if we hire someone like Torben or Dacheng to predict the future, right? So let's say, suppose that let's say Dacheng were able to predict the average future direction in certain interval, right, given delta. But this prediction is imperfect, right? So with certain probability, P, the sign being flipped, right? So in other words, with certain probability, sign being flips. So if you are able to peek into the future, predict a little bit into the future, someone has some special ability. When P equal to 0 means you have perfect knowledge about the future average trade direction. The predictability increases from 15% to nearly 28%, nearly doubled. Right? So the double the predictability. So how do we use this additional variable? Right? So just one variable about the sign, imperfect knowledge of the sign of the future. So we just doing interaction with every variable in our model. So we just double the variable by including interaction of this variable with the remainder variable. So out of sample R squared doubled. And now if you have imperfect knowledge, let's say P equal to, so with 90% that your predicted sign is correct, then is, I think it's still 22%, quite high. And then of course, when you get to, let's say 60% right, so you still have a little bit edge, right? So when you get into the 50%, there's no edge at all. So this is the value of future direction. So that shows that any company who are doing this, right? So if you have proprietary prediction of the future average direction, that will give you a lot of edges. Similarly, this is for the accuracy of direction. So we increase from 64%, around 64% to nearly 80% of the accuracy in terms of the sign. So the time value of the data cannot be understated. So let me just quick summarize, right? So based on 100 stock, or more precisely 101 stock over 505 days, right? So we studied the return, direction, and duration. And we basically showcase that the prediction universally exists and across different stock and across different, different date. And the predictability is strong, but deteriorate also with long time horizon, which is expected. We also identify the features with prediction power, and in particular, we showed like order book imbalance, transaction imbalance. They are universally powerful for both return and the durations. And if you are interested in the return prediction, so past return is a powerful predictor too. So, but not for the volume, for the duration, but the volume statistic is powerful for duration prediction. And in particular, more recent one has better prediction power. And this is another way of reflect that the time value of the data. And we identify the determinants and the environments that impact on the predictability, and we demonstrate the value of timeliness. And with this, let me thank you all for attention.
All right, thank you so much for a very interesting talk. In the interest of time, we'll have to postpone the remaining questions to the informal session. And without further ado, let's welcome Professor Torben Andersen from Kellogg to deliver a discussion for this paper.
Thank you.
Torben.
Let me try and share my screen, I guess.
Oh, sorry, I have to stop it. Sorry, yeah.
Yeah.
Okay.
Okay. Okay, you see my slides now?
Yes, please go ahead.
So that's great, that's great. Okay, so thank you very much for asking me to discuss this very interesting paper. And it has two titles here, as you can see. The one was the one that came from the paper. I think that's the official title, How and When a High Frequency Price is Predictable. And the other one came from the slide deck that they were kind enough to share with me. So without further ado, time is short, so let me jump right into it. So I think this paper fills an urgent gap in the literature in the sense that machine learning techniques have now been taken to a lot of interesting questions or important questions in asset pricing. It's still very, very much in the infancy, I would say. We're still struggling to understand how the machine learning gets combined with more structural understanding of what's going on in the markets and things like that. But I have not seen before serious papers on ultra high frequency return predictability through robust machine learning techniques. And I think this is what this paper delivers. There are no real substitutes for this. I guess one obvious predecessor is the just recently published paper in RFS by Easley, Lopez de Prado, O'Hara, and Zhang. I have some reservations about exactly how they proceed in that paper, but more importantly, they do not directly address return predictability. They look at other market microstructure kind of features of the market and predict those. So it's not a substitute, let's just put it that way. Another, interesting style of work that's related to this, but doesn't go nearly as broad, is what I call Rama-Kant style parametric dynamic order book models. These are electronic order book markets. So essentially you only get trades when you hit the bid or the ask in the order book, in the limit order book. And hence there's a literature that uses the order books and the transactions or trades and quotes and dynamically try to relate the two. And that's also very interesting, but it's parametric. Here we get a more comprehensive non-parametric approach, and that's certainly good. They use lasso variant or random forest. Random forest is one that performs the best, especially over the shorter horizons. So most of my comments will really go on that. I am not an expert in machine learning per se. I'm not going to critique the particular approach they took in the paper. I will leave that for other people in the audience who are more attuned to the recent literature in machine learning. What I will more reflect on is the links to the economics of market microstructure and what to make of their results in some sense and how important it is from an academic perspective, perhaps. So their empirical results are easy to summarize in some sense. They predict the size of the returns and the direction of the returns and other things, but let me focus on the return predictability. And it's easier to do that for the boring stocks, the low volume, low volatility, low price, low beta stocks, the ones that don't do too much. They are easier to predict. The primary predictors that help you predict, let's say the 5-second returns, are the trade imbalance. So they're using a trade classification scheme that tells them whether they were active buys or sells in the market. If they look at the difference between the two in the very recent past, if there's buying pressure, more active buys than sells, well, the buying pressure pushes up the price predictably. The returns, the past returns are a negative predictor of the future returns. So that might be some bid-ask bounce effect. It's not entirely clear from reading the paper if that is the main reason. The order book imbalance, well, if the bid depth in the order book is much higher than the ask depth, it's much easier to break through the limit order book to the ask side. And that also means you can predictably say that the returns are going to be positive. And finally, there's this immediacy or low volume thing. If the volume is low, it's easier to kind of predict. So another thing to keep in mind is that the valuable high frequency information used is really, really recent. So it's the last 0.1 second that seems to matter the most. Now that sounds like an awfully short period of time, and it might be at the order of magnitude of where you can even react. It's hard to react that quickly. However, the data is given in nanoseconds. So let me say a second is actually 1 billion nanoseconds. So once you start stretching time into nanoseconds, this is 100 million nanoseconds. And to the extent you can react in nano or microseconds, it's a fairly long period of time. So the machines can use this, at least potentially. Okay, the other aspect of the paper in terms of brief characterization of what they find is that stock characteristics or market conditions do matter for the extent of return predictability. If there's a large tick size, you can more easily predict returns. You wonder again, is that kind of a bid-ask bounce thing that gets larger as the tick size gets larger, because the tick size might be binding, at least at some times. There's a bunch of variables here that are related to this boring aspect that I said. So if it's a low volume, large spread, low volatility, low jump activity, low VIX, and that's correlated with high market return at that point in time. All these boring things, again, makes it easier to predict things. The low beta, I'm a little bit worried about the beta estimates, because you estimate them over such short periods at such high frequency that I think you might get a downward bias in the estimated betas, which might be correlated with how liquid the stock is. So I don't know. I think that's probably not necessarily 100% robust, but I think thinking about the beta in this context is really important. And I will talk more about betas shortly. And finally, there's the time of day effect, which is kind of interesting. It's easier to predict things at the close than versus the open. Okay, so in order to summarize this, I think Jianqing said in the following way that the results make intuitive sense. Yes, I think also they're interesting but largely expected findings. We know high frequency trading tends to generate pretty steady predictability or pretty steady profits. That is consistent with there being at the micro level, at the ultra high frequency level, predictability. We know that the more illiquid the stock is, the more predictable probably it is, because there's more frictions and more time to see what's going on. And we know that trade or limit order book imbalances are strong indicators of where the price is moving in the very short run. So, and they find all these things, which is reassuring. The things that are a little bit harder to interpret is, what does the tick or the spread actually mean beyond mechanical bid-ask bounce effect? Is the impact here larger than the tick size, or is there more to that? The volatility in VIX thing, when volatility is high, things are harder to predict. It doesn't necessarily mean that high frequency trader is worse off, I think, because volume usually goes up with high volatility. And that means they can do more trading, or they can do more, benefit more from just market making at the bid and the ask. If the spread goes up, I kind of think the folklore is that high frequency trading firms really like volatile environment where things get thrown off a little bit and you see inefficiencies. But I guess that's something to study in the future. I'm not completely, I wouldn't map the lower predictability into lower profitability is kind of what I'm saying. The low beta stuff, it's a little bit hard, as I said, to completely interpret, I think. And I think the open close is very interesting. I'll say more about that, but again, it doesn't come out in the paper what might be the reasons underlying that. So now what I'm going to spend the rest of my time on is picking, like most of my rest of the time is picking 4 themes that I think is worth contemplating deeper to try and understand the results they found and how it might relate to our views of the microstructure of the markets. I found this little quote here that, you know, they don't really give any indication of why it could be easier to predict returns at the close than the open. I think it's not so surprising. In fact, the market microstructure literature and a lot of recent papers emphasize that there's a big difference between how the markets function in the morning and the evening or late afternoon. And for instance, we know the price impact is much higher in the morning, the spreads is higher, the limit order book is less deep at the opening hours, and the volatility per trade is higher at the open than it is towards the close of the day. This is on average, but it holds incredibly robustly, I think. And so to illustrate this, and we've been thinking about this in recent work, if you estimate beta at different times a day, but you use many days, so you're kind of focusing on a given stock's beta at different points in time over the day. And I think we use somewhat lower frequency data than they use in this paper, but we think it's actually fairly robust. We at least get the betas have a mean around 1. So if you look at the dispersion of the betas around 1 at different times within the trading day, this is captures, this is day T, and we are adding a little bit, a fraction of the trading day, and we're letting kappa run across the trading days. And we measure the dispersion, the cross-asset dispersion of those betas. If you measure that, you see it decline universally from the morning to the evening trading. And how can that happen? How can the betas change so much in terms of their cross-sectional distribution? Well, what happens is that things like Caterpillar, which has a large beta, market beta, has a declining market beta throughout the day, like 20% drop here from 1.35 almost to 1.12 or something. And the one Johnson & Johnson, which is a very low beta stock, goes from 0.55 up to 0.71 or something like that. This is a pretty robust phenomenon across the stocks. So you start thinking, gee, what is so different between the morning and the evening? Well, the beta dispersion I just pointed to, but if you think a little bit deeper, firm-specific news are usually released overnight, earnings announcements, other things, because otherwise you have to halt trading if you come up with surprising news in the middle of the day. Macro news tends to come relatively early in the day, except for the FOMC. And what happens at the end of the day is that you have portfolio rebalancing, daily execution targets have to be met, so there's a lot of trading at the end. There's performance benchmarks that incentivize institutions to trade late through the value-weighted average price, for instance. So you are trading closer to the average price of the day when you know the volume is high at the end of the day, so that you know what you're doing. So risk aversion would tend to push you towards trading at the end. And so you can think of there being an uninformed pooling of trading at the end of the day, where the lower price impact makes it easier to trade big volumes. So things are very different in the morning and the evening, and it's nice to relate that to the predictability, I think. Okay, so that was theme one. Theme two, I wanted you to dig a little bit more into the tick size issue and the spread issue. Let me not belabor this point too much, but is the past returns predicting future returns negatively because of a bouncing in a tick? Do you ever predict more than one tick move in the returns over 5 or 30 seconds? You could predict the bid prices in the future and the ask quotes, bid quotes and ask quotes instead of the midpoints or instead of the trade prices. Does that also get into predictability? That kind of takes the bounce out of it. So a lot of those things I think would be nice to understand. The third thing I looked at or thought was very inspiring, and you do trade classification as a part of constructing the trade imbalance measure. And this was the trade and quote data. And actually, here's a +1, so indicates that this particular trade should be a plus. I think in your slides, somehow it changed to a minus. And so maybe my question falls away, but I constructed a consolidated quote and trade record by putting the quote and trade record together in the timing. And these are in millions of nanoseconds. So you can see this stretches about 53,700 nanoseconds or 54 microseconds, this sliver of the trade and quote history. And for Intel, I think. And you see that there's a, these are the quotes that you see here. And then there's actually a trade here. They recorded this as a sell. That's because it hit the recent bid. And later on, they have a positive here. Now, if you truly follow the Lee and Reddy, I would argue this should be a negative. But maybe this is simply a typo in the version that I got. And I think the slides that I just saw had a minus here. But so that was actually a question to how you implemented the Lee and Reddy procedure. Maybe I shouldn't make too much out of that. But what I really wanted to know is Lee and Reddy, when I grew up, we used to have use a 5-second delay rule. I think the recent literature says that things react so quickly now that you don't need to lag at all. So are you using the quotes to help you identify bid or buy or sell trades without any lag? So that's literally a question. It's not entirely clear from reading the paper if you're doing that or you have some delay in terms of classifying the trades relative to the existing quotes. Let me say that these things are incredibly difficult to do with precision. This trade classification, whether it's active buy or sell, because of all these features that happen in modern markets with the fragmentation, the regulation NMS, which splits trades into little pieces and sends them across markets. You have non-synchronous kind of delays in various places in this network that connects traders with exchanges, and then the dissemination, excuse me, of information through the consolidated order NBBO kind of setting. So it's actually very hard to figure out with 100% precision whether these are buys or sells unless you have the exchange trading flag in your data. One way where you can actually do this really nice is this Globex. If you have a Globex-like system where the futures like at the CME, you actually have only one trading platform, and you can kind of use the sequence of trades to help you out get a better classification. So I'm very interested in how the precision with which you can get these order imbalances and trade imbalances in particular determined. Finally, let me talk a little bit about return predictability. It declines with the information delay due to a lot of effects. Let me not, given the time delay, think too much about that. But let me point out that this relationship between return predictability and profits is quite a bit more complicated than you might think at first reflection. And this is a paper by people from Urbano-Champaign, Li Ye, and Zhang. They point out that the regulated NMS and their national market system is a consolidated quote system that creates these NBBOs that's used in this paper as well. And what is important is that it forces people, when they submit marketable orders, to get routed by the brokers to where you get the best price. But that's gross price, it's not net of fees. So you can actually get sent to execute elsewhere where it's not in your interest if you include the fees that are associated with the routing. So there are these orders that come with do not ship. They simply cancel if you are told to route. So you can actually do that legally. And there's these intermarket sweep orders that also deals with the complications. The important thing is that 57% of orders do avoid this. So the NBBO is not really hitting 57% of the orders that we see. Why are people doing that? Well, they're doing that because it's profitable to avoid this routing. So take the NBBO data with a little bit grain of salt. And what they show in this paper is that regular orders lose money. So the regular market and limit orders on average lose money to these other guys who are avoiding the reg NMS. And who are especially in the short run making money out of this? This is the high frequency traders that just run speed races. They almost make sure they are never routed. There's a different group of people or institutions that make money or more long-term strategies. These might be minutes or half an hour rather than just a few seconds. And they tend to be routed. So there's two different types of trading institutions that make money. So let me try and summarize now. The point of that previous slide was that profitability is much more complicated, and understanding the implications of this predictability is not just the speed races, which I think they're probably capturing in this paper, but there are many more interesting things going on. It's a much more dynamic environment if you start to think what return predictability might mean and how it ties in with market microstructure effects in general. So to summarize, I found the results not too surprising or shocking, but they are certainly illuminating. It has deeper interpretation of the results would be great for future work. I mentioned these 4 things that were themes that you could look at. And let me just, as a last thing, mention that some of these results seem to indicate to me that what we usually call noise in high frequency volatility modeling will be correlated with where the efficient price seems to be going in the future. So that means we might rethink sometimes, if you look at really high frequency data or regular semi-martingale setting. I have some work on that that's forthcoming. We might occasionally see episodic strong drifts. How do we deal with that? Well, there are these papers where you can kind of deal with the drift and that's kind of what these predictability stories say, that there are certain conditions where you can actually predict in relatively short run whether prices are going up or down. And what's important is that that predictability shifts around. It's not like one stock is going up all the time. We have these different short run predictabilities up and down that comes in a sequence. And finally, I think some of the variables that characterize the trading of a given stock actually take on momentary equilibria. There's almost this trading invariance happening in its short equilibria that ties together the trading intensity, the trading volume, the return volatility in that environment, and the trading cost that's captured by the tick size. And that, so there's a kind of very interesting invariance in the variables that help you predict the returns itself. And I think getting a handle on that will also give us a more holistic picture of what's going on. So interesting paper. I loved reading it, and it gives a lot of inspiration for thinking about the economics behind this all. Thank you.
All right. Thank you very much for the insightful discussion. And because of my failure to managing the time, we will take a very quick response for Professor Jianqing Fan. Would you like to?
Okay, sure. Torben, thank you very much for various insight on the economic of microstructures, and you, give various very valid points. So very thankful we haven't posted this paper anywhere, so still give us a chance to study and look more into the future. In particular, you have given us also a lot of very useful, very useful references that we certainly would like dig into it. And so I like you. Would like also to thanks that you have given us various summarize on the four very interesting effect that we need to study. So before I get to that, let me just say that first of all, I agree with you that using 15 seconds to compute to compute beta does have some kind of drawback on microstructure. So we were just using that just to see there's a certain error invariable there. So we use this just to see how market beta actually impact on the return. Unless we're using a very complicated algorithms, the error invariable is always there. And I also would like to thank you for point out potential mistake that we have on the Lee and Reddy classification and how we actually use the algorithm. Indeed, we didn't invent our algorithm ourselves. We just used the SAS algorithm being provided, but we'll definitely look more into that. And so you give a lot of insights on the the time of the day effects, and we all know that there's a heterogeneity. There's certain news arrival during evening and news arrival during morning have different. And we all know that the early morning are also more volatile, and the volatility, high volatile one, definitely make it harder. To predict. So we didn't dig as deep into that. Probably some aspect we can dig deeper and see why one make actual difference between morning to day and morning and the day and the time effect. So as I said, as you said in your in-depth description, the trade classification, there's a lot of issue to it. Again, we didn't really doing ourselves on trade classification, just using the SAS algorithm that being provided. And I like your mentioning, let's say, the predictability, particularly our conclusion tend to say that when you are in the highly volatile markets, using our algorithm alone, we didn't say the other more proprietary algorithm cannot take advantage of volatility. Using our algorithm alone, we can yeah, I mean, the high volatility environment is harder to predict, but maybe there exist other algorithms that actually designed for high volatility like that. Now, the high frequency profit, I mean, that part, I mean, unfortunately, I do not really know much how they actually make the profit, but that interaction indeed is very interesting, right? Exclusion part, I think probably is one of the weak part for most of our academic like you and me. But I think you point out a very important issue that how profitability and predictability and profitability, I mean, interact each other. That would be certainly require a different paper or another person to study, but you point out a lot of very interesting things that we'll certainly dig into it. And this is comes right in time as we already, I think, holding the paper for quite a few months without doing anything. So it's maybe the next is a good time to move again on the paper and investigate a few issues that you point out here. So thank you for the end. Yeah.
All right, thank you so much for both of you for your insights today. I apologize that we have to defer our discussion to the informal session. I still have two announcements that I have to make. First of all, the next seminar is going to be on November 15th, delivered by Paolo Zaffaroni and Patrick Gagliardini. And there's another seminar coming following this one in December. And we're gonna invite PhD students on the job market to submit your job market paper, and our organizers, the four of us, will select some of them, and it's a great chance for you to practice your talk and for us to see. All right, so please submit your papers as soon as possible. Thank you very much. All right, so now it's time to end today's session. Thank you for coming, and we will move on to the informal session.